delighted to have with us today Michael Hudson, an investigative financial journalist and author of a new book on the mortgage crisis, which I suspect may be the reason why we have so many people from the community here. Mike is also a 1985 graduate of Washington and Lee, where he was not only a journalism major, but also a point guard on the basketball team, I just learned. He says that much of what he learned about digging deep and looking into public records, he learned while a student here at the J School. And he also said that this is a far bigger turnout than he ever had while playing basketball. It's a particular pleasure to welcome one of our own here today as a Reynolds Visiting Fellow. This is a program made possible by the Donald W. Reynolds Foundation. One of the foundation's goals is to improve the quality of business journalism across the country. And we feel giving students and faculty a chance to hear from someone with Mike's credentials is a great way to accomplish that. The press has been correctly blamed for having missed the origins of the subprime mortgage phenomenon, which ultimately led to an international financial crisis. But a few reporters were paying attention all along and writing about a financial system that preyed on people who could not afford large mortgages and high debt. Mike Hudson is one of those few. Columbia Journalism Review called Mike the reporter who beat the world on subprime abuses. Mike began stringing for the Roanoke Times when he was still a student at W&L, and he kept working at the Roanoke Times after he graduated. In his 20 years there as a reporter, he covered just about everything, but he developed a reputation as someone who was skillful at finding rich stories in public documents. After leaving the Times, Mike became a freelance reporter, and he had considerable success publishing substantive pieces on banking and lending abuses in the LA Times, the Washington Post, the New York Times, and a well-regarded journal called Southern Exposure. These pieces led to a position at the Wall Street Journal, and he has since moved on to the Center for Public Integrity, a nonprofit, nonpartisan research organization based in Washington, D.C. that concentrates on ethics and public service issues. Mike has received considerable professional recognition for his work, including the John Hancock Prize and the George Polk Awards. These are among the highest honors that a financial journalist can receive. And his book, which was published just last month by Henry Holt Company, has been already receiving impressive buzz. Its title is Monster: How a Gang of Predatory Lenders and Wall Street Bankers Fleeced America and Spawned a Global Crisis. One reviewer said it reads like compelling fiction, but the story is all too real. Mike has already been interviewed widely about the book on NPR, Bloomberg TV, and PBS's Need to Know, to name a few. And he was featured recently in The Week magazine. Mike will be signing copies of Monster after the talk in the Huntley Hall foyer, so I hope you'll visit him down there and buy a copy. Mike's talk today has a title almost as long as the book's title. Subprime Nation, an investigative reporter untangles the hidden history of the mortgage crisis and the struggle for financial reform. But I know you will find he has a gift for breaking down a complex topic into an understandable tale. Mike will be happy to take questions after his talk, but please join me now in welcoming Mike Hudson.
I just want to get the thank yous out before they're forgotten at the end. I really want to thank Professor Lucky and everyone else in the journalism department and the Commerce School for bringing me down here. And I was really sort of shocked when I got my itinerary and it said I was the Reynolds, I think it said Reynolds Distinguished Visiting Fellow. And if I'd have known I was distinguished, I would have brought a tie with me. I forgot it. So I just want to launch in to just kind of set the tone. I'm going to get to some of the issues, but just set the tone for a few quotes from my book. And I may replace some of the profanity that these are what the words people are saying with euphemisms. So you'll just have to fill in the blanks. But here goes. I'm just going to give you a few. Just imagine you're watching a movie trailer and you're hearing the kind of, you don't know exactly who's saying it, but you're hearing, I became a thief, and unfortunately, I found I was a very good thief. We are all here to make as much dag-blamed money as possible. Didn't say dag-blamed. Bottom line, nothing else matters. Anything that benefited production, that benefited me and benefited my wallet, I do it. It's hard to have a guilty conscience if you don't have a conscience. This is going to be a little off color. Roland could be the biggest bastard in the world and the most charming guy in the world, and it could be minutes apart. I can't read this next one. It's just too. Deep down inside, he was a good man, but he had an evil side. When he pulled that out, it was bad. He could be extremely cruel. People don't need access to predatory lenders. That's like saying people need access to poison or children need access to mumps. If you don't find the true pain, you won't write the loan. Imagine what happens if the housing bubble burst. These people, you had all the confidence in them in the world. Tell them to do it. Tell them to do whatever it takes to close that loan, or it's his rear end. It didn't say rear end. Let's compare W-2s. I made over $2 million last year. What did you do? There's nothing more dangerous than a sales presentation in the hands of a salesman. Your people find too much fraud. And then finally, a subprime billionaire, mega political donor, and one-time U.S. ambassador, Roland Arnall, explaining in testimony before Congress why his company, AmeriQuest Mortgage, had engaged in widespread predatory lending. And I'm not using euphemism here. This is exactly what he said. He said, stuff happens. So I wanted to address first some of the sort of talk, what I see as sort of the talking points and myths of what happened. This has been a terrible thing for a lot of people. People have lost their homes. People are worried about losing their homes. The taxpayers have been soaked. There's a lot of pain to go around, and this is a very difficult thing to get our brains around. And I think there are some talking points that are out there that either are inaccurate or just need more context. I was doing like a virtual telephone radio tour the other day, and I talked to lots of people, stations all over the country. I got to be interviewed by Alan Autry, who's the former mayor of Fresno, California, who you will probably know him better as Deputy Bubba on the TV series In the Heat of the Night. Also, there were many radio hosts, including the gang at Mayhem in the AM at WLKF in Orlando, who wanted me to explain how Barney Frank caused the financial crisis, how he was the patient zero, so to speak, of the mortgage meltdown. And they were rather indignant when I suggested that it might be more complicated than that. Now the talking point goes like this. We start with Frank, who's a liberal member of Congress. He talks with kind of a Boston accent that's Boston, Massachusetts, not South Boston, Virginia, that many people in the heartland may seem odd. So Frank defended the two large mortgage giants, Freddie Mac and Fannie Mae. And Fannie and Freddie, by the way, were the causes of the mortgage crisis. Therefore, Barney Frank caused the mortgage meltdown. So the logic here is pretty tight. I think we have to understand we can understand why some folks would want to spread this talking point far and wide. And I understand why a lot of people would latch on to it. Partly it's sort of simple to remember and repeat. It's like Barney, Fannie, and Freddie. It's like a kid's cast of a children's TV show. I should note parenthetically here that the gospel-inflected bluesmen, the Holmes brothers, had a song called Fannie Mae where they were pleading for Fannie Mae, won't you please come home? And that Mississippi bluesman Model T Ford had a song called Sally Mae about how Sally Mae had done him wrong, and I think that inspired the New York Attorney General Andrew Cuomo, who's now the governor, to launch his investigation of the student loan industry, but that's a subject for another day. Anyway, the Fannie and Freddie talking point rose very, very strongly in the aftermath of the Lehman Brothers fall and the general disaster and disarray in September 2008. And during a debate in October 2008, John McCain said, one of the real catalysts, really the match that lit this fire, was Fannie Mae and Freddie Mac. They were the ones that went out and made all these risky loans, gave them to people who could never afford to pay back. And also in late 2008, the Republicans on the U.S. House Committee on Oversight and Government Reform issued a report that declared Lehman Brothers didn't cause this mess, but it certainly jumped headfirst into trying to make money on securitizing mortgage-backed securities. They followed on the heels of Fannie Mae and Freddie Mac. If we understand the initial cause of the cancer at Fannie Mae and Freddie Mac, then we can understand how it metastasized at Lehman Brothers, Wachovia, Countrywide, and beyond. Now, there's one problem with this conclusion. It's tiny, really, but it gets Fannie Mae's and Freddie's and Lehman's roles exactly backwards. Right. Lehman had been a leader in the market for subprime mortgages long before Fannie and Freddie followed Wall Street into these riskier loans. From 1996 to 2006, and every year except 2001, Lehman Brothers ranked first or second on the list of underwriters, packagers of subprime mortgage-backed securities. CNBC host David Faber has written, Wall Street actually rushed into the vacuum created by the absence of Fannie Mae and Freddie Mac in 2003 to 2005. They were actually, at this point, they were under pressure from Congress and federal regulators in the wake of some accounting scandals. And according to Faber, Fannie and Freddie retreated from the market they had dominated for the past 20 years. They began buying fewer mortgages in a period when people were buying and refinancing more homes than ever before. As a result, Fannie and Freddie's share of the secondary mortgage market, in other words, mortgages that are bought and sold and traded after the initial mortgage transaction, dropped from 70% to 30% from 2003 to 2006. So think about that. From roughly the start of the boom to the pinnacle of the boom, Fannie and Freddie's market share dropped from 70% to 30%. So it doesn't take an economics degree to understand that they weren't necessarily the main forces driving the growth of the housing bubble and the practices on the ground. So the point is this, Wall Street banks like Lehman Brothers, big banks like commercial banks like Citigroup and Washington Mutual, and a growing menagerie of independent mortgage lenders, most of them based in Southern California, created the subprime mortgage boom and the mortgage feeding frenzy of 2003 to 2006. I mean, they were the ones who fueled all the bait and switch salesmanship and document forgery and other kinds of fraud, all of which we're going to get into later. By the same token, the Wall Streeters and the big banks and the Orange County-based, California-based mortgage lenders, they created, invented, and peddled all these crazy loan products that created the bubble and caused the crash. The hybrid 228 and 327 ARMs, which were these sort of fixed-rate, adjustable-rate mortgages stitched together in this sort of Frankenstein's monster-like amalgam, pay-option adjustable-rate loans, interest-only loans, and a no-doc stated income loans. I should note there that this stuff wasn't limited to only the U.S. I was talking to a British book agent the other day, and he told me that they didn't use the terms no-doc or stated income in the UK. In the British fashion, they referred to them as self-verifying mortgages. So, you know, but still, while a lot of the mortgage craziness that grew up in the U.S. got exported overseas, the worst stuff was really here in the States. And back to our point, or rather talking point, I don't want anybody to think that I'm letting Fannie and Freddie off the hook. Fannie and Freddie played a role in this, a significant role, but not as leaders. They were mostly followers. First, to a large degree, they were bystanders, not in no way innocent bystanders, but rather the problem was they sat by while the mortgage market was going out of control, but instead of using their market clout and their bully pulpit and their lobbying influence with folks like, yes, Barney Frank and other members of Congress to help police the market and rein in the bad practices, they sat by and allowed things to sort of fester and grow. In some cases, they also joined Wall Street and the banking industry and the rating agencies like S&P to prevent tougher regulation of the mortgage industry. Then, as the boom started heating up and their market share, they saw their market share plummeting, Fannie and Freddie began loosening their standards and backing more and more of these risky mortgages. The New York Times described a meeting that took place sometime in 2004, 2005 between Angelo Mozillo and Fannie Mae's chief executive, Daniel Mudd. Fannie bought a large volumes of just Countrywide's regular plain vanilla loans, but Mozillo was one of them to buy the riskier mortgages too, and he told him, you're becoming irrelevant. You need us more than we do, and if you don't take those loans, if you don't take these loans, you'll find you'll lose much more. And then, according to a source that attended the meeting, he offered everyone in the room a breath mint. Now, Now, and again, this is Fannie's excuse shouldn't be like Flip Wilson's "the devil made me do it." It shouldn't be like Mozilla made us do it. They had a choice. Fannie and Freddie made choices to go into the market, and their size and their clout helped in the end to take what was going to be a disaster and make it a much worse disaster, increase the pain, and help spread out the pain in a larger way. So I want to address one other talking point before we go deeper into the story. It's the idea that something called the Community Reinvestment Act, that through the Community Reinvestment Act, the government forced banks and lenders to make risky loans to minority and low-income families. The Community Reinvestment Act didn't say anything about making subprime mortgages or push stated income loans or other risky products. There was a study by the Orange County Register, a daily newspaper in a conservative area, most familiar with subprime lenders, found that nearly 3 out of 4 dollars in subprime loans made in 2004 to 2007 came from companies that weren't covered by the law. The biggest and baddest subprime lenders, Ameriquest and New Century, for example, weren't covered at all by the CRA. And even the American Bankers Association, which is not a fan of the CRA, says it just isn't credible to blame the law for the mortgage meltdown. The truth is that Ameriquest, Washington Mutual, and the rest made these loans because they were wildly profitable and because Lehman and other Wall Street powers turned on the pipeline of cash and incentivized them to make as many loans as possible by any means necessary. So let's get back to the start. Where did it all begin? Did it begin with banking deregulation under Jimmy Carter in the late 1970s to some degree, with even more aggressive banking deregulation under Reagan in the 80s? Yes, to some degree. With a similar cycle of significant banking deregulation under Bill Clinton, followed by still more deregulation under Bush too. Those are all good places to start. I touch on those briefly in my book. I even tried to go back at one section and had a long section in the draft about real estate frauds in the 1880s in Southern California. All this stuff wasn't invented in 2003, but I had to cut that out because of concerns for space and cohesion. For me, the narrative really starts in the 1980s. There was a guy named Roland Arnault. You've heard his name earlier. He was an immigrant from France. He came to the U.S. around 1950. He and his brother got their start selling flowers and tomatoes on the street corner in L.A. He eventually became a real estate developer. He learned about sort of backroom dealing and perhaps even influence peddling in and around L.A., where, like in many places, there's a very tight relationship between the real estate interest and the political power brokers. Ultimately, he opened up at SNL at a time when the state of California and many other places were really, sort of had lowered the barriers to taking over an SNL to starting one extremely low. He had the idea of using it to bankroll his own development projects, and he did some of that. But as the rest of the SNL industry was crashing and burning in the late 80s, he figured out that he could make lots of money doing high-priced loans to borrowers in mostly minority neighborhoods. That was really the birth of the modern subprime industry. At first, people running the business for him and I've talked to a lot of people who ran the business for him in that era. They kept the lid on his more aggressive instincts, but like many empire builders, he pushed out the folks who'd started the business with him. We all saw, well, many of us probably saw the Social Network recently. We saw that scenario play out. But also pushed out the people who acted as a check on his behavior. In the early 1990s, the SNL regulators pressured him about his corporate governance style, asked him to make some changes, bring some non-family members onto his board. So his response was to give up his SNL license. He actually drove up and hand-delivered and said, "Here, I'm done with you." And he morphed his company into an independent, lightly regulated mortgage lender based in Orange County, California. And he created a business structure where doing whatever it took to book loans was the rule. Folks I talked to who worked for him said that Roland felt like loan volume solved all problems. If one of his underlings projected us, we can do X amount of loans in this period, his response was always, "Oh, we can do twice that much." One of his execs told me he would push you He would stretch you beyond what you thought possible. Whatever you did, no matter what you did, it wasn't good enough. And that's fine in a business setting to do that. You should have high expectations for people. But the question is you also need to monitor the results, like what are the things that are actually happening? How are your customers being treated? So each month, as the numbers grew bigger, he would throw a celebration to mark the new record, and then he would decree that the record was now the floor. They had to beat that, beat that the next month. And for him, it was all about exponential growth. Customers were at a disadvantage in some of these transactions because, according to people I interviewed, some of the Long Beach employees weren't above forging the bar's signatures on the loan disclosure forms told them what they would be, how the loan was going to be structured and what they would be paying. One of the former loan officers told me this was pretty much standard procedure. A lot of people just thought workers thought this was junk paperwork. Sometimes the sales manager would tape documents up on the office windows and use the light streaming in to help them trace bar signatures from a document they'd signed to one they hadn't signed. And this guy noted, he said the laser printer paper they used in those days was thin, and it really made it easy to do this kind of forgery. AmeriQuest and the subprime lenders were able to start really growing in the mid-90s, in large part because Wall Street realized they could make a lot of money here. Back in 1995, as it was starting to get into subprime, Lehman Brothers sent a vice president out to Orange County to check out another lender called Famco. He came back and wrote a really scathing memo that said this was a financial sweatshop that specialized in high-pressure sales to people who were in a weak state, a place where employees checked their ethics at the door. This apparently didn't bother Lehman much over the next few years. It helped Famco raise hundreds of millions of dollars to bankroll its lending and continued bankrolling the company even after other Wall Street firms decided they wanted nothing to do with Famco. So through the alchemy of securitization, Wall Street and the mortgage industry were able to create this incredibly complex system where loans were sliced and diced and investors around the world could buy a little piece of the U.S. mortgage market. It was a system that was all about diffusing responsibility and accountability. If the loans went bad, the thinking went the risks were spread out among so many investors that the pain would be lessened. More important for American consumers, it created layers of insulation between those borrowing the money and those who actually own the loans. Normally what would happen is a mortgage broker would sniff out the borrowers, arrange the loan, then the loan would be closed in the name of a smallish mortgage lender, then it would sold up the line to a bigger lender, which sold it to a Wall Street investment bank, running out of breath, who then pooled it into something called a special investment vehicle or a bankruptcy remote shell corporation, much like the shell entities that Enron used to hide its accounting shenanigans. Then it sold what were called mortgage-backed securities, which were underpinned by the income stream from these loans to investors in Australia, Belgium, you name it, California, public employees, a pension fund. If the borrowers complained that they'd been a victim of predatory practices, bait and switch salesmanship, forged documents, and so on, all the bigger players, and the investors could say, "Oh, not me. That's not my fault. That was somebody else down there." But it was likely that the mortgage broker or the smaller lender had gone out of business, was operating under a new name, or had moved to another city or state. So there was no one, there was no one to sue. So this lack of accountability really helped fuel the spread of fraud and the do and say whatever it takes to sell a loan mentality. Wall Street had such a voracious appetite for these loans that fair dealing and common sense went out the window. So how prevalent was fraud? The secretive nature of fraud makes it difficult to put a number on it. I can only say that every company I investigated with any depth appeared to display significant levels of fraud. I interviewed 200 former industry insiders, and they were forthcoming, often effusive, about how much fraud was going on. And I just didn't take anybody's sort of statements at face value. But eventually, when you talk to, say, a loan officer in Kansas City, and he says, "Oh, we were doing this at our branch. This particular practice is our branch," and then you talk to a borrower in San Francisco who says this same thing without prompting, says this same thing happened to me, you begin to think, "Oh, that's interesting. Maybe it's not just a few rogue employees." And then when the scenario is repeated in various combinations around the country, you start to see the bigger picture. I spent a lot of time talking to folks who worked at AmeriQuest Mortgage, which was the last version of Roland Arnold's mortgage empire. The practices that had been going on in the mid-90s at Long Beach Mortgage emerged with a vengeance at AmeriQuest a decade later. They told me that at the sales branches, employees outfitted the break rooms or spare cubicles with all the tools they needed to create fake tax documents and other paperwork that they needed in the loan approval process. Whiteout, who knew you still needed to use whiteout? Whiteout, X-Acto knives, Scotch tape, and they dubbed these workplaces the lab or the art department. And these fraud-enabling workshops made it easy for loan officers to qualify for borrowers for mortgages they couldn't afford. It was simple. You paste the name of a low-earning borrower onto a photocopy of a W-2 tax form, the thing you get at the end of the year that tells you how much money you made or how little you made, belonging to a higher-earning borrower, run the cut and paste through a Xerox machine, and like magic, you have a piece of paper that makes a bad loan prospect look suddenly better. A former loan officer at AmeriQuest recalled that the system of rewards and punishments made it clear, you should do whatever it took. He said anyone who wasn't doing bad things was getting replaced. The people who were doing the illegal things were the ones making the money and getting the promotions. And of course, as people got promoted, they hired people like themselves to replace them, and because they would make money. If you were a branch manager, a regional manager, et cetera, the income that was being produced by the people down below, sort of in a Ponzi-like way, was sort of would flow up. You'd get a little piece of that. Some of the strongest evidence that fraud was condoned and even encouraged from the top comes from the internal gatekeepers within industry. These are people like, names like risk managers, or they were in-house fraud investigators, loan underwriters. And I talked to a lot of these folks, and I read their testimony and many others, and the story that they told was consistent. They did their jobs, they found fraud, but instead of being rewarded or even promoted, they were ignored, marginalized, harassed, demoted, or fired, or some combination of the above. One case is the experience of a woman named Amy Strapp. She was a sheriff's detective down in western North Carolina. She investigated murders and other big crimes. She decided she wanted to get into corporate investigations, so she took a job at BB&T Bank as a corporate fraud investigator. And within fairly quick order, she helped uncover a $100 million mortgage-based real estate Ponzi scheme that BB&B had provided substantial financing for. And according to Strapp, when the FBI came in to talk to the bank about this case, a company told her he didn't want her in on the meeting. And she asked him why, and he said, well, because if they ask you a question, you'll answer it. So a federal administrative law judge later ruled that the bank had retaliated against her by firing her for doing her job and pushing her too hard on the Ponzi investigation. And as I said, I've talked to several other people who had similar experiences. So, how are we doing on time? So what was the effect of all this fraud? We've got millions of American families, as I said, millions of American families under foreclosure, or the threat of foreclosure. In September, 1 out of every 374 American homes was the subject of a foreclosure filing. Those are the numbers. I want to end by talking about one real person. Carolyn Pittman dropped out of high school to go to work. She never learned to read or write very well. She worked for decades as a nursing assistant. She and her husband, Charlie, who was a longshoreman, in 1993, they borrowed $58,000 to buy a little one-story concrete block house in a working-class neighborhood of Atlantic Beach, Florida. Their mortgage was government insured by the Federal Housing Administration, so they got a good deal on the loan. They were paying $500 a month on the FHA loan, and that included money to cover their home insurance and their property taxes. Charlie died in 1998, and Mrs. Pittman tried to keep up with the home payments, but things were tough. I mean, financial matters weren't something she knew much about, and Charlie had always handled what little money they had, and her health wasn't good either. She had a heart attack in 2001 and was back and forth to the hospital with congestive heart failure and kidney problems. So like many older African-American women who owned their homes but had modest incomes, they were house rich but cash poor. She was deluged almost every day by mail and by phone with sales pitches offering her money to fix up her house or pay off her bills. A few months after her heart attack, a salesman from AmeriQuest called her up, got her on the phone, and assured her he could ease her worries. He said AmeriQuest would help her out by lowering her interest rate and her monthly payments. She signed the papers in August 2001. Only later did she discover the loan wasn't what she thought it was going to be. Her interest rate jumped from a fixed rate of 8.4% to a variable rate that started at nearly 11% and could climb up much higher. The loan was also packed with more than $7,000 in upfront fees, or roughly 10% of the loan amount. Her monthly mortgage payment climbed to $644. But even worse, the new mortgage didn't include an escrow for real estate taxes and insurance. Most mortgage agreements require the homeowners to pay a little extra, like $100 to $300. That's set aside, and then the mortgage company actually pays the home insurance and the taxes to ensure they get done. But what many subprime lenders did is they obscured the true cost of the loans by excluding the escrow from the deals, and that made the monthly payments look lower. And many homeowners didn't learn that they'd been tricked until they got a big bill for unpaid taxes or insurance a year down the road. But that was just the start of her mortgage problems. Her new mortgage was a matter of public record. And by taking that loan from AmeriQuest, she signaled to other subprime lenders that she was vulnerable, that she was financially unsophisticated, and she was struggling to pay an unaffordable loan. In 2003, she heard from another one of AmeriQuest's competitors, Long Beach Mortgage Company. She had no idea that Long Beach and AmeriQuest shared the same corporate DNA, that that Long Beach had been Roland Arnold's first subprime lender, or that many of the people who now worked at Long Beach and AmeriQuest were folks who had learned the business under Roland Arnold. So a salesman from Long Beach basically told her the same story. He could help her solve her problems created by the AmeriQuest loan. Once again, she signed the papers. The new loan from Long Beach cost her thousands of upfront fees and boosted her mortgage payments to $672 a month. AmeriQuest reclaimed her as a customer a year later. A salesman from AmeriQuest got her on the phone again, spring of 2004. He promised once again that refinancing would lower the rate and their monthly payments. And she wasn't sure what to do. She knew she'd been burned before, but she desperately needed to find a way to pay off the Long Beach loan and regain her financial bearings. She was still pondering whether to take the loan when two AmeriQuest representatives appeared at her house on Irex Street in Atlantic Beach. They brought a stack of documents with her. They told her, she later recalled, that this was all preliminary paperwork, simply to get the process started. She could make up her mind later. Then they took her through sign here, sign here, sign here as they flipped through the stack. She didn't understand that these were the final loan papers and that her signature was once again binding her to AmeriQuest. To push the deal through and make it look better to investors on Wall Street, consumer attorneys later alleged someone at AmeriQuest falsified Pittman's income on the mortgage application. At best, she had an income of $1,600 a month, about $1,000 from Social Security, and when he could afford to pay about $600 a month in rent from her son. AmeriQuest paperwork claims she brought in more than twice that, $3,700 a month. The new deal left her with a house payment of $1,069 a month, nearly all her monthly income and twice what she'd been paying on the FHA loan before AmeriQuest and Long Beach had hustled her through these refinancings. She was shocked when she was required to pay more than $1,000 a month on her mortgage. That broke my heart, she said. But for AmeriQuest, the fact that she couldn't afford the payments was really, at least in the short term, of little consequence. Her loan was quickly pulled with more than 15,000 other AmeriQuest loans from around the country into a $2.4 billion mortgage-backed securities deal known as AmeriQuest Mortgage Securities, Inc. Mortgage Pass-Through Certificates 2004-R7. The deal had been put together by three of the world's largest investment banks, UBS, JP Morgan, Citigroup. These banks oversaw the accounting wizardry that transformed her mortgage and thousands like it into investments sought after by some of the world's biggest investors. Slices of the deal got snapped up by giants such as the insurer Mass Mutual, by Legg Mason, a mutual fund that had clients in more than 75 countries. Also among the buyers was the investment bank Morgan Stanley, which purchased some of the securities and then placed them in something called its limited duration investment fund, mixing them so they could rub shoulders with investments in General Mills, FedEx, JCPenney, Harley-Davidson, and other household names. This was the new way of Wall Street. The loan on Carolyn Pittman's little one-story house in Atlantic Beach was now part of the great global mortgage machine. It helped swell the portfolios of big-time speculators and middle-class investors looking to build a nest egg for retirement. And in doing so, it helped fuel the mortgage empire that in 2004 produced $1.3 $3 billion in profits for Roland Arnault. That's for him, not for his company, but he took that out personally in 2004. Carolyn Pittman fought for years to save her home. She prayed every day. "I'd like to keep it if I can," she said in 2007. "I thought I would live here the rest of my life, what little life I had." And she feared the worst, so she had her things in boxes stacked in the dining room, even as another one of AmeriQuest's Wall Street allies, Deutsche Bank, pursued a foreclosure action against her. AmeriQuest's sales machine continued to crank out mailings, offering her yet another loan. The letters came twice a month. Bold-faced type proclaimed, "Slash your monthly payments." So I think I'm going to take questions now. So